There we go. There we go. There we go. Sorry, people. I had a few technical issues with my camera there for a second, so I do apologize. I do apologize. But as they say, the show must go on. First of all, can I welcome every single one of you to today's little Market Bites webinar, which I'm doing today. Now, this is going to be a bit of a series because I had a few requests on other webinars we've done where people have said, can we do a little bit of educational stuff? Because I know the previous episodes have been a bit more topical as well as educational. Today, we're going to do more educational. And one of the topics which keep coming up is fundamental analysis. So the idea is we're going to do a series of fundamental analysis webinars. And today we are going to start off with something which I'm quite passionate about, because when I started in the industry about 20 years ago, it was all about this. Technicals were just, a little bit of sort of like bunting, a bit of, dressing back then. Obviously, technicals for Forex has now become more sort of dominant, but I really think fundamental analysis or understanding fundamental analysis is vitally important. So anyway, let's start and crack on, as they say. So, yes, so this is going to be fundamental analysis part 1. And today I decided to go and discuss commodities. Commodities. Now, before we start though, don't forget, these little webinars, videos, etc., are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So, first of all, a little bit about me. Those of you who kindly joined me on my previous webinars, you know a little bit about me already. I've been in the financial service industry now for over 20 years. Okay, I started off as an IFA back in Blighty, back in the UK, and I sort of specialized in mortgages and commercial financing. Now into the trading arena about 2006, so again, nearly 20 years in total. And I did trade gold options, and gold is my first love. Those of you who know me already, you know I like talking about gold, through the Dubai Gold and Commodities Exchange when it was like really taking off. I worked from several very well-known established brokerages. I've been a portfolio manager and an educator. Now, I've been sort of teaching or trading or mentoring, so to speak, for over 10 years now. And I'm well-known public speaker. I've spoken at several expos, events, and things around the world with related topics. I'm also a really avid market commentator. I love talking about the market. And what was up in there? There we go. I don't know what happened there. And and like I say, I'm a gold lover. So anyway, today's topic is fundamental analysis. This is part 1. Okay, this is part 1 of the series. Now, first of all, why do I want to talk about fundamental analysis? Why do I want to talk about technicals? Why do I want to talk about fundamental? Well, it's simple. In the retail trading market, there's so much focus on technical analysis. With new traders sort of looking for like the holy grail, of technical indicators to find success. They all think if they can just find that one indicator, they're going to be successful. And though I will say this, technical analysis does play a huge role in becoming a successful trader, especially in finding potential entry and exit levels and establishing the potential trend of the asset. The core driving factor of an asset's value is driven by market sentiment and fundamentals. Now, in fact, if you actually talk to institutional traders, they rarely talk about technical analysis. Instead, they discuss more about the fundamentals to spot potential trading opportunities. And like I say, if you watch Bloomberg, what do they talk about? They talk about the fundamentals, breaking news, earning reports, market sentiment, how the market's feeling, what's driving it. Very rarely do they talk about technical analysis. The only time they talk about technical analysis is maybe when they talk about the 200-day moving average, like the Death Cross, for example, the Golden Cross. They very rarely, they don't go into Bollinger Bands, RSI, things like that. They don't, do they? They don't talk about that. They focus on that. Now, for one, I'm not saying that technical analysis does not play its part in trading. Of course, it does. It helps you identify an entry and exit level, a trend, maybe a changing of the trend, but that's backed up by fundamentals. So really you should use the two. So I'm not underplaying. But anyway, and like I say, I started off nearly 20 years ago trading gold. It was all about fundamentals. It wasn't about technicals. It was all about supply, demand, and what was causing gold to move. So in some ways, I just want to get back to basics as well. Now, what is fundamental analysis? Now, fundamental analysis is a method of determining an asset's intrinsic value, as in real value. So he looks for the assets, which are maybe trading at prices higher or lower than its actual value, the true value of that asset. If the asset is trading below its true value, then it's considered undervalued and presents a potential buying opportunity. If an asset is trading below its true value, then it's considered undervalued and considered a buying opportunity. So overvalued, a potential selling opportunity. Undervalued, a potential buying opportunity. So that's what they are considered looking at. So overvalued, selling opportunity, undervalued, buying opportunity. Now, fundamental analysis gives the investor an opportunity to look beyond short-term price movements. And this is the other thing. Again, it depends on your trading style as well. Okay, it looks beyond the short-term price action or price fluctuations, the short-term noise. Instead, it focuses on really the underlying factors that will determine an asset's long-term performance. Now, there's two types of fundamental analysis, especially for stocks, and that's going to be part 3, by the way. Quantitative and qualitative analysis. It's easy for me to say. Now, quantitative, this is where the investors look at information that can be shown using numbers, figures, ratios, and formulas. Qualitative analysis, this is where the investor looks at the asset's quality, standard, nature, what it actually does. Now, let's break down the different commodity groups. Okay, we have soft commodities, we have metals, and we have energies. Starting off with soft commodities, feeds the world. Now, these include the likes of cotton for clothing, coffee beans for your coffee. We've got a coffee right here. Cocoa beans for chocolate. Wheat for bread. Sugar and soya beans. Now, like most commodities, this is a key thing. When it comes to trading commodities, especially soft commodities, there's two things you need to bear in mind: supply and demand. If you have an increase in supply and decrease in demand, it then means the prices might come under pressure. If you have a decrease in supply and an increase in demand, then obviously the prices will potentially go up. Now, soft commodities, these are agricultural produce, which means we need to think of crop production and what can affect the production, such as weather conditions. So you need to ask, has there been a good harvest? How can they affect supply? A random question out there. One of my favorite films about trading, it's actually more of a Christmas comedy, is Trading Places. And that's what introduced me to the trading world all those years ago, the film with Dan Aykroyd and Eddie Murphy. And they were trading concentrated orange juice. So they looked to crop reports to try and guess the value of concentrated orange juice. Great film if you're in the mood for a comedy. Now, how do we find this? Well, you can go onto the official website. The information is out there. You can go and see it. It's not hidden. You can go on to, let's say, the United States Department of Agriculture, for example, and they give you statistics of crops, weather, and things like this, how the crops are doing. They often produce little reports like this example here, corn crop progress, what percentage of quality was it? How much is grown? Is it better than expected or lower than expected? What's the quality of it as well? Because if the quality is no good, they're not going to be able to sell it. Things like that. Soybean crop progress. And these reports are out there for you to find. And they obviously do breaking news as well. When there's certain reports about certain crops not doing so well or certain things impacting them. Again, all this information is out there. All of this can be found. And again, gives you an idea of supply. Now, there is another thing you need to take into consideration as well. What countries produce such agricultural produce? Now, let's take coffee beans, for example. One example, okay? Coffee beans, okay? Brazil, they produce 40% of global supply. Vietnam, 20% of global supply. Colombia, 8.4% of global supply. Indonesia, 7.1% of global supply. Ethiopia, 4.3% of global supply. So why do we need to bear in mind what's happening with these countries? Well, we need to find out what's happening with them. Because if something happens to them, it's going to potentially affect supply. Here's an example. Ukraine is the 9th biggest producer of wheat in the world. Once called the breadbasket of Europe, producing over 26,208,980 tons of wheat a year. A major provider. Now, obviously, it's still in the headlines today. But you look at the outbreak of war in Ukraine back in February 2022. When that happened, wheat prices skyrocketed. Why? Because it could potentially impact supply. So again, this is why we need to think about what's going on in these countries who produce these goods. So this is a prime example. The other aspect you need to consider, of course, when you're trading, soft commodities, is government policies. The change in government can maybe impose restrictions or subsidies, which can indeed affect supply. Tariffs is the word nowadays, for example. Interesting, but I don't know if anybody watched, I think a lot of people did, watch the tariff when I did a couple of years ago. We talked about the chicken war, an example of that, back in the 1960s. So like I say, sort of examples of like post-tariffs, like I just said, export ban on certain crop. If the crop material is not up to say maybe a produce from one country doesn't meet certain standards of another country, then that's going to affect supply. So they're banned from going out. I mean, you can look at the eggs situation at the moment. That's inflation, But it's also, we got a problem with crop of eggs, the eggs coming in. So that's affecting egg prices. So those are all these sort of things, it's a bigger picture you need to take into account. And registering demand. Here we go. Registering demand. That's supply. How do we register demand? Well, obviously, as it's agricultural, it's food majority. It's affected by population growth or economic growth and consumer preferences. Don't forget. For example, if a population is growing, the need for food products such as wheat and corn will increase. If the economy is growing, so will potential demand for luxury products such as coffee and cocoa, more chocolate, more fancy coffee from Starbucks. So that's the sort of thing we need to bear in mind. As well as that, if the consumers have become more health conscious, then maybe the demand for products like sugar might fall off. So, excuse me. So these are some of the things you need to bear in mind. That's how we can register demand. Now, fundamental analysis for metals. Now, those of you, I think I recognize a couple of you, who've come to the last couple, know that obviously I'm going to talk about gold again. We always talk about gold, but gold obviously is a metal. And we already established the key fundamental analysis to gold already. So, yes, I see you, Assad. I see you there, buddy. So, yeah, so I'm going to be talking about gold again. 100%. Yes, of course I am, buddy. Good to see you. Really good to see you. So anyway, let's go over some of the other metals. We will talk about gold, obviously, but let's talk about some of the other ones. We got gold, obviously, silver, which does tend to follow gold, by the way, even though it's used more for manufacturing and technology than gold. Copper. I'm from the West Country, so when I say copper, it sounds funny because I roll my R's. Platinum and aluminium. Just so you know, that's how you probably say it. It's aluminium, not aluminum. Anyway, these are some examples. So first of all, when you're looking to trade metals, you ask yourself, what is that metal used for? Now, the majority of metals are used for manufacturing. However, one such metal, we all know what it is, though it's used in some forms of manufacturing, like, for example, there's some of it in my phone. It's an attraction to investors for different reasons, and that's for being a safe haven. And hands up in the room, what that is, or what metal I'm referring to, is, of course, gold. And for those of you who are new to trading, what is a safe haven? A safe haven is at times of uncertainty, such as conflict, recessions, economic slowdown, smart money moves to what's called a safe havens out of riskier assets. It's called the flight to safety. And safe havens include the dollar, the Japanese yen, Swiss franc, and obviously gold. Now, example of conflict, for example, it's not just economic slowdown. Conflict impacts the gold as well a lot. This is an example of the Arab Springs, which started back in 2010. Started off in Morocco, I think it was, and then spread. And as you can see, there was a lot of upheaval for those years. And gold skyrocketed because people were very nervous about the ongoing situation there. But as soon as it stopped when the Egyptian president stepped down. I can't quite remember his name now. I think it's Mubarak, I'm not quite sure. As it dropped down, then gold dropped because everything started to calm down. So this is the thing about gold as well. It's like not just economic slowdown and economic concerns. Gold shines when there's potential conflict, or indeed there is conflict. Let's talk about the other metal. Let's talk about copper. Funny, I know I say it funny. Now, copper is used for many different types of manufacturing. So if there's economic growth, copper can rise in value as demand increases. You think about it, it's used for piping, wiring. It's used in all sorts of forms of manufacturing. If there's like growth in construction, things being built and demand for it, obviously the prices are going to go up. However, if there's economic slowdown and demand will fall, resulting in copper prices falling. So if there's not economic growth, we're not building so much, we're not making so much stuff because there's not so much demand for it, then copper prices are going to drop. So because it's a manufacturing metal. So this is something else we need to think about and bear in mind. And here's an example. Here's a perfect example, really. This is the figure on the left. Okay, you can see the source of where it comes from. This is economic growth output. And as you can see, obviously, in 2020, because of the lockdown, because of COVID, economic growth dropped dramatically. And as you can see on the chart on the right of it, so did copper prices drop dramatically because they couldn't build anything. We were all locked in at home. Nothing was happening. So prices dropped dramatically. But as soon as economic recovery started to grow again after the initial lockdown period, and certainly around 2001, etc., copper prices started to build and rise again, obviously. And as you can see the line, you've got the developing countries, you've got the world, and you've got developed countries. So you can see the growth pattern there. When everything started getting back to normal, copper prices peaked. Then come 2022, we had obviously inflation issues, as you can see here, inflation issues, and copper prices started to drop down again. So again, need to understand what that commodity is used for and if there's demand for it and what's happening in the world. So copper is an industrial metal. And finally, and then we'll do the Q&A sessions, obviously, going on to fundamental analysis for energies, the main thing which drives the world. Now, energies obviously include the likes of WTI oil, Brent, and natural gas. Now, first of all, let's look at the top 10 oil-producing countries in the world. United States, Saudi Arabia, Russia, Canada, China, Iraq, United Arab Emirates, UAE, Brazil, Iran, and Kuwait. Now, again, like with the softs, we need to be aware of what's happening in these countries. Okay, because if something's happening in these countries, then it's going to affect price of oil. Prime example, Ukraine-Russian war. Well, we put a load of sanctions on Russia. Affected supply, didn't it? So the prices went up. Iran, for example, it's got several sanctions against it. When sanctions get lifted, when that increase supply, it will, which could potentially, again, affect price of oil. So this is why, again, same as what I discussed with soft commodities. When we look at energies, we need to think of the countries which supply this stuff to us. The other thing we need to bear in mind, and these guys can really move the market quite rapidly, or oil prices, and it's OPEC, and that's the Organization of Petroleum Exporting Countries. Now, this is like a cartel, and it allows the cooperation of leading oil-producing countries to influence and control the prices of the global oil market. So they try and keep it stay to where they want it. And they can do this by either limiting supply or increasing supply. So they can suddenly say, well, we're only going to we're all in agreement, all going to agree to only produce 50,000 barrels a day, keeping it level, keeping the prices. The prices start to drop, then it's, now we're dropping it down, we're only going to produce 20,000 a day. If they start increasing production, like they say they want to go to 100,000 barrels a day, they can do that. And that can lower oil prices. So they have this sort of like this, they can decide where roughly they want the oil prices to go. I mean, there's other factors in it which we're going to discuss as well, but it's not just them, but they do have quite a big influence. Countries in OPEC include the likes of Saudi Arabia, UAE, Venezuela, like I said it, Iraq, Iran, Nigeria, Kuwait, Algeria, Gabon, and Libya. That's just a couple. There's a few more as well. You've also got OPEC Plus, which is like a few additional members who's not officially part of OPEC. Now, like I say, this organization, this is why they got so much influence. It counts for 38% of global oil production. And it's estimated that 79.5% of oil reserves are located within the OPEC nations. And like I say, they meet frequently throughout the year and they can decide whether to increase production or lower production, which in turn can affect supply and oil prices. Now, here's the top 10 oil consuming countries. United States, number one, China, India, Russia, Saudi Arabia, Japan, Brazil, South Korea, Canada, and Germany. Now, why is this important to know? Well, if there's economic strife or economic slowdown, then guess what? Demand will fall. Now, I saw this several times. Whenever we get the concern about China, they're one of the biggest, consumers of oil. If there's slowdown in their industrial complex or their manufacturing, it can impact oil prices because the market goes, well, if their industrial industry is slowing down, or if their manufacturing is slowing down, or they're facing global hardship, they're not going to need as much oil. So again, it affects prices. So not only do you have to be aware of the countries which produce the most oil, you also have to be aware of the countries who buy the most oil, because that can affect prices too, for obvious reasons. Now, like again, this is where it's another prime example again, which we saw. Again, 2020, we locked down. Nobody needed oil. We couldn't do anything. We were stuck at home, no industry, and oil prices collapsed. As soon as we start getting back on our feet and growth output started to rise again, oil prices started to rise again, as you can see. There we go. There we go. I thought I had another slide. I thought I had natural gas. Well, natural gas, same thing. Same thing as oil. We look at the countries who supply natural gas. Anyway, is that wrong? No, I'm not wrong. I'm sure I had a slide. My apologies. I thought I had an extra slide about natural gas. Anyway, any questions at all or any comments? A couple of comments coming here. It's like a race on you can type the fastest. This is great. I love this part. It's my favorite bit when I do these things. It's talking to you guys. Okay, first question. This is Sari. Concerning WTI, it is one of the most assets traded, yet is not as volatile as gold or other assets. Why is that? Again, there is a lot of volatility with oil, but don't forget, like I say, one of the big influences with oil is OPEC, where they can try and control the prices, and that's why they try and control it. I mean, you do see a lot of volatility with oil. I mean, it's not as dramatic as gold, but it still very much can be. You see, I mean, again, it's a different thing. Gold has its own attractions, like it's obviously ETFs, for example. Economic. There's a lot more data which can affect gold, where the market can get nervous and change market sentiment. Oil is really deep down affected by supply and demand. So that's why it appears to be not as volatile, but it is still volatile. But it's supply and demand issues. Gold is not necessarily supply and demand. It's more about what's going on in the world as well. But great question. It was a brilliant session and everything was clear, but there's one basic question. How do you filter out the news about those countries and see whether it would have a necessary impact? Great question. Now, like I say, when so oil is easier to understand because to work out what's going on. Because if there's conflict like in Nigeria, or indeed in say the Middle East in general, then obviously the market looks at it and goes, okay, this is going to affect supply. And we often get those headline news on all the main newspapers, don't we, about that. If there's something happening in Brazil, for example, which you can find from the news like BBC, things like that, then of course you need to think, okay, maybe there's a trading opportunity with coffee, for example, because there's maybe an uprising going on or a military coup which can affect coffee prices. So really, it's just keeping in touch with news. And then, prime example again, what happened with Ukraine? I mean, again, it's maintaining sort of all the information you can about. I can start again that before I answer it. One of the most valuable things in trading is an idea. Okay, is an idea. That's one of the most valuable things. And diversification. So when you want to diversify your portfolio, and say you want to do a little bit, say maybe soft commodities. Okay, you have a look at some of the circumstances. You know, it's not out there. You need to dig it, but the information's there. So you think, oh well, I'll tell you what. You hear a news report of a very bad harvest with cocoa beans or something in certain countries who do cocoa. You think, well, okay, that's an opportunity. So you do your research to find out what's going on with that. You know, so it's really a case of just trying to keep yourself in the know of what is happening in the world. Like I said, oil is easier because there's a lot more headlines in relation to oil than there is to soft commodities. For metals, it's all about economic data, you know, like growth, which affects copper prices, or concern, which can affect, obviously, economic slowdown, which can affect gold. So that's, you know, it's really a case of trying to keep yourself in the know. A great question, buddy. Great question. Good to see you as well. Is gold still the best to trade among all those mentioned in this session? Look, I'm a gold bug, so I love gold. And Assad just said below you, gold is the best. So it's a very good question. I wouldn't necessarily say it's. I mean, I'm a big fan of diversification in your portfolio. You should never have, there's an old British saying, you should never have all your eggs in one basket. You should diversify. Gold is very good hedge against riskier assets, but there's always a good other commodities like copper, like things like that, and silver as well. You can trade. I wouldn't say it's the best. It's my favorite. Doesn't mean it's the best. So that's no advice, but it's also can be extremely volatile. So again, there it does depend on your attitude to risk, because it's very, very fast moving. It can be very, very fast moving. So you need to be aware that it's volatile. And again, it also depends on your trading style. For example, if you're a short-term trader, then you can potentially scalp it. But I'm a position trader, and I often look at the long-term picture where I can handle the volatility. But good question, very good question. Okay, another great question from here. Sorry, in big countries, well, mostly China, are not always honest about supply and demand. Is the asset effective regardless of what they say to it, or is it dependent on what they say? First of all, very, very good question, and a very, 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 very good point. Yes, they aren't very honest. Okay, they're not very honest. Now, oil prices are impacted on what the information we get from them. And what tends to happen with the market, okay, is they try and estimate, because they know China's not always going to be honest. Okay, same as they're not honest about how much gold they've bought recently. So the market tries to double guess if it's true or how bad it is. So it doesn't necessarily depend on exactly what they say, where the market tries to determine whether or not they are telling the truth or if it's something even worse. Because at the end of the day, the market's always about trying to decipher whether or not it's correct or not, or whether or not what the impacts can be. But that's a really good question. But yeah, it can, what information they can give out to us when they do release the information, sometimes it is truthful and it's open. It affects the market. Even when it's slightly, the market looks at it and go, to double guess if they're telling the truth or not. But it can still affect the price, the asset, regardless of what they say. Good question. It's a great question. Actually, Assad, that's very good. Not relevant to this session, but since we're talking about gold, we're always talking about gold, buddy. Did you get the time to see the chart I shared? I haven't, to be absolutely open with you, buddy. I had a quick look at it. I haven't had a quick. I've only had a quick look. Haven't really had time. But what I will say, mate, it was brilliant. What I initially saw, I will spend some more time looking at it properly. But it's brilliant analysis. I was really impressed, and thank you so much for sharing it with me. But I will come back to you properly when I've had a proper time to have a look at it. But that's brilliant. Another great question here. Okay, I've noticed lately that economic news didn't have the expected impact like it used to have on gold. What sort of economic news are you thinking about? You thinking about like NFP, things like that? Or CPI, that sort of stuff? First of all, yes, okay, NFP, yeah, okay. Right. Here's the thing. Here's the thing. The market focuses on one story at a time. Okay, that's the thing with the market. It doesn't focus, it focuses on one thing at a time. So if the market is transfixed, for example, on the job market, and it's all the headlines are about the job market, then that can impact an asset's value, so impact like gold. Okay. If the market is focused on inflation, then yes, that can impact the market rapidly. Okay. If it's not, then you can see maybe potentially the asset react, but not as much as it should do if the market's focused on it. Now, over the last couple of obviously trading weeks, okay, even though I think inflation is a bigger problem and it's coming soon, I think there's a bigger issue with inflation. At the moment, it's not too obsessed with it. What really the market is obsessed with, like with gold, is obviously the economic slowdown which they're worrying about and tariffs. There's another reason why I think gold prices are bullish, and they have been for a long time, and there is potentially a possible strong uptrend, is I think physical demand is going up by the reserve banks. Because as I said in my session last week when we discussed gold, even though S&P now is, which I knew was going to happen at some point, gold and S&P should go opposite. But a couple of trading sessions last week, they were going the same, which sort of says to me that this has been more affected by demand than it is by economic indicators. When the story focuses on the job market again, and it's all about the job market, then that will make gold react. If it's all about inflation, and that will come up again, I'm sure of it, then it will react more with that sort of data. At the moment, though it does have an impact with it, it's not as much as it used to. I really appreciate it, mate. I appreciate it, mate. I said I was so touched that you shared it with me, man. And what I looked at it was really, really good. Very, very good. Okay, here we go. Right, Ricardo here. Some treaties that end conflicts have promises of trade benefits to both sides, like the GFA in Northern Ireland. How does that affect the market? Since conflicts increase the price, how can these treaties affect it? What a fantastic question. What a brilliant question. Now, obviously, if conflict, again, it's very much, if conflict sort of affects the supply, then it can affect the price of it. However, if there is certain treaties, like trade treaties, to try and ratify stuff, then that can balance the price. Because the whole point of some of these treaties to get people for peace, but to have trade benefits is to balance the price as well, to make it not so dramatic that it will take a while for countries to recover from such conflicts. So it depends on what the actual treaties are there for and what they actually say, for example. So again, it is really dependent on what the actual proposals are. But in theory, the idea should be if the conflict's ended, supply goes up, but the treaty, which will affect the prices. But if a country is rebuilding and needs the money to rebuild, such treaties are then put in place to balance the price, so they can obviously benefit to rebuild. But that's a really good question. It can indeed affect the market depending on what the treaty is and what the commodity is. Now, I can't think of the major commodities coming out of Ireland, to be honest, apart from Irish whiskey, maybe. But that's a great question. Very good question. Ricardo, very good. Thank you for coming. Thank you for asking that great question. Really good question. Actually, all the questions today have been brilliant. As always, guys, you guys never let me down. You know, you never let me down. You're always, thank you. No, big thank you. It was a brilliant question. It really was. No, guys, you guys never let me down. Whenever you come to my little webinars, you always were chatting away, and I love your input because your foresight, your insight is excellent. Like I always say, don't forget, I never claim to be an expert in this. I just share a little bit of what I know and hope that it helps you find your own way. That's the idea. But it's lovely to see all these comments. Any other questions? I think I said you were going to write me a question, were you, bud? I think I saw you type in away. Here we go. Excuse me. Oh, that's a salary question as well. Excellent. Okay. Right. First of all, would you be short in the American defense companies and long in the EU ones as Europe is trying to be independent from America? That's a fantastic question. And to be open with you, I think that is one way the EU is going to try and punish America a little bit for it. They are. But this is going to be a long-term thing. Okay, they're not going to be able to build everything straight away. But in general, at the moment, I would be looking at EU stocks over US stocks, no matter what industry they're from, apart from the AI ones. But even they are wavering. I mean, Nvidia in particular, we'll have to see what that happens today. But that's a great question. I think there's going to be a huge surge in EU defense stocks. I don't think. No worries, buddy. No worries, buddy. But I think, I mean, but then it's not just EU buy US military, is it? They sell all across the world in Middle East and Asia. But I think the EU would take a big. I think the EU will, if we get these trade tariffs, and if communication keep coming, then yeah, we will punish them that way by not building their own military or buying their own stuff and investing in our own. I mean, the UK has already started to do it. They did it a couple of years ago. They started developing a new fighter plane because they did buy a load of F-35s for their aircraft carriers from the Americans. But now they decided to go back and start building their own stuff again. It's called the Tempest, which is under development. So yeah, I think EU stocks would be. I would look at EU stocks over US stocks at the moment anyway. No, I don't think it'd be that dramatic for the American defense companies because they've got a big wide market they sell to. But EU stocks would definitely go up a lot higher. Brilliant question, though. Excellent question. I love these questions, guys. These are awesome. As much as this is Sareen, as much as Trump is working on having a stronger, better country, how much is he working on taxes, making dollars stronger? How is gold still going up in his bullish momentum? It showed a bit of drawback this week, but still has potential to heading up. Okay, as much as Trump is working on having a stronger, better economy, how much is he working on taxes, making dollars stronger? Let me answer that. Let me ask that question first. Again, this is the big problem. Is he going to make the US economy stronger? That's the big question. Is he? And this is what the market's double guessing. Okay, he's going to do tax breaks, and I think that's gone through Congress. It's got to go to the Senate now, which in theory frees up a lot of capital, doesn't it? But also, those taxes go to pay like for a number of unemployment people, and more people are being laid off. So it's a little bit of a theory that we've got more money in our pocket. We can spend more, but that's no good if prices are going up. You see what I mean? It cancels itself out. So if you have tariff situation, okay, and inflation going up already, this is going to add to inflation. So though I might have a bit more money in my hands because I'm not paying taxes, it's going to cost me more to buy that. So there is generally no benefit, and there's certain groups of people who need the money, which we get from taxes and services and things like that, don't benefit. So I think he had. I'm not. He's been president twice, and they voted for him twice. I'm not quite sure he has the idea, and I think this is what makes the market really nervous, because he's also he's temperamental what he does, and this is what he double guesses. And like I said, I tell you something, which should be interesting. This is where we can really judge what Trump does. I have no doubt he will do something. If the S&P 500 drops to around below 5,700 to 5,600, I bet Trump will do something to try and boost it again. He will do something radical, which won't work. Because one thing he's very, 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 very pedantic about is he judges his performance on how the stock market is doing. And if the stock market's not performing in his watch, he takes it very personally and thinks, because he thinks he's amazing, so he thinks it should be. But I don't know. This is why I think gold is still going up, because people are not convinced. And like I said, the main reason I think gold is going up is more central banks are buying physical reserves. I think people are buying it, but they're buying it. That's why. But I think gold's still going up because the market is nervous. They don't think what Trump is saying is going to work. And tariffs never work. Never work. So, yeah, great question. And yeah, he did draw back, but I think that was more about a profit taking. I mean, he drew back yesterday, was trading at $2,912, I think. It's still above the trend line. It's still got in. I think about a profit taking is natural for that sort of movement. Asad, thanks so much. No, mate, you're awesome. Okay, here's a good one question. On the basis of seasonal analysis, gold falls from mid-February to the end of mid-March. So the recent fall was due to that reason, if it's historical behavior and nature. It also booms in January, usually. But we're now coming into the end of Feb. It hasn't really dropped a lot, has it? Now, I think a lot of people look at the seasonal thing, and there is something to it. I don't always pay attention to that, though. But that's a valid point, though. That is a very, 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 very valid point. And like I say, history does repeat itself, and I'm not denying that. But yes, it's valid. I mean, even when it comes, I only think the game's over with gold when it comes under that trend line. But yeah, good question. Any other questions at all? Anybody else? Oh, thank you for your time. No, thank you for coming. Thank you. All my thanks go to you guys. Because I mean, look, so I've been doing little webinars like this for years. And the reason why this is the best, I enjoy this the most, is because you guys chat and we talk and we share ideas. And that for me is amazing. And you guys take the time out to come and see me. And I love that. It really does. It makes all the difference. This is why I enjoy it so much. So thank you all. Thank you so much for everything. Thank you so much for educating us and finding us valuable questions. You're welcome. Thank you. No, thank you, Asad. You're a legend, mate. You're an awesome chap, and I love you. Ricardo, is there any new session coming up soon? Yes, next week we'll probably do fundamental analysis part 2, and this time we'll focus on currencies. So yes, we're definitely doing another session every week, buddy. Every Wednesday around what's it, 1 p.m. GMT, I'll do a webinar every Wednesday on any particular topic. If you have topics you want me to cover, of course, let me know, and I'll write the material for that. So that's is there any team on here where we should join, like to access recordings like this or files? Okay, first of all, if you registered, then you should get the video sent to your email address afterwards, the recording, because this is obviously recorded. As well as that, okay, it's not quite like this. It's not quite like this, but every day on our YouTube channel, okay, I do a live broadcast, okay, on YouTube, and it's like this, but it's a different type of format. Like this, it's live. You can ask me questions and we talk and we discuss what's going on in the market. It's not so much educational, it's more analysis on what's happening and what the story is. But you come and join me on there. That's about 3 p.m. GMT, so 5 p.m. Cyprus time. That's on our YouTube channels, which is Run Royal Official YouTube, and click on live because there's a live show. I usually do that around about 5 o'clock my time. So in about an hour's time, I'll be going live again on YouTube, so come along for that. Oh, you're welcome. Thank you. No, my pleasure. My pleasure. Okie dokie, guys. First of all, a massive shout out to all of you. You've all been absolutely amazing. Really has. It's been so good. And I love these little webinars because you guys are just the best. Absolutely the best. And like I say, I hope you see me on some of my lives. Don't forget, I do my live show on YouTube every day, around about 3 p.m. GMT every day. So feel free to come along and see me on that. And I will be back next week doing another webinar like this. So again, we can talk, and I'll probably, like I say, I'll do fundamental analysis part 2, which will be currencies next week. Anyway, till then, don't forget, these little videos are for educational. Let's take the screen off actually and do it properly. There we go. Anyway, don't forget. Sorry, I forgot something. I need to do something quickly. My fault. There you go. I forgot to show you this, of course. Anyway, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.